The second paragraph in our ROE decomposition analysis will focus on the profit margin. We want to begin by telling me overall again what happened to overall profitability. We can really just restate the sentence from our opening paragraph that LA Gear's profit margin declined from 9.85% to 3.47%, which is roughly half the industry average. Then you're going to identify the factors that contributed to the falling profit margin and any factors that offset the overall trend. Let's evaluate those first on our worksheet. The easiest place to do that evaluation is rather than using our profitability ratios, we can focus on our common size income statement. It really has all the information we need. Let's begin with what happened to our overall trend with our profit margin. That's the net income on a common size income statement. Overall, the trend has done what? It went from 9.8% down to 3.47%. It has decreased, which is worse, and we are now lower or worse than the industry average. The next step is to identify which factors caused our profit margin to go down. So that's simply going to be the items where our costs increased faster than our sales. Let's take a look at cost of goods sold. We were at 57 cents in cost for every dollar in sales. That has now increased to 65%. So cost of goods sold has increased, which when our expenses go up, that's worse. And that has contributed to our declining profit margin. And at 65 cents on the dollar, we are worse than the industry average of 60.6 cents on the dollar. SG&A is a percentage of sales. We were spending 23 cents on every dollar. We're now spending 26 cents to generate every dollar in sales. So SG&A has increased as a percentage of sales. This means it's worse. It has contributed to our falling profit margin. And at 26.2 cents, we are worse than the industry average of 23 cents per dollar in sales. Let's take a look at depreciation expense. Depreciation expense has gone from 0.2% up to 0.38. So depreciation expense has also increased. The evaluation would be that's worse from a profitability perspective. It is contributing to our falling profit margin. But as far as depreciation expense goes, we are better than the industry average. It's gone up, but we're still better than the industry average. Next, interest expense as a percentage of sales. We were spending 1.8 cents in interest expense for every dollar in sales. Now we're spending 2 cents on interest expense for every dollar in sales, which is higher than the industry average. So interest expense has also increased. Notice the theme here. All of our costs are going up as a percentage of sales, which of course is worse and has contributed to our falling profit margin. So we are, on interest, we are worse than the industry average. The only bright spot is our income tax expense as a percentage of sales. And the only reason it has gone down is because we are less profitable. We were making 16 cents in profit before taxes. We're now down to 6 cents in profit before taxes. So we would expect to be paying less in the area of taxes. So tax expense as a percentage of sales has decreased. From a profitability perspective, we could say it's better, but it's not really clear. Because, yeah, tax expense went down, but it's gone down because we're less profitable. This has offset, however, what? The overall trend, right? It used to be we were spending 6 cents on every dollar in taxes. It's down to 2%. So it has offset the overall trend, and our tax expense is better than the industry average. The one thing we want to figure out, though, is what has happened to our overall tax rate? Because remember, we have a progressive tax rate system. So our tax expense will be a function not only of net income, rather taxable income, but also our tax rate. We can calculate our tax rate real quick. We do that by simply taking our tax expense of $15,000 and dividing it by our taxable income of $37,000. In the first year, we were spending 41 cents, or rather our marginal tax rate or average tax rate was 41%. Now we're paying taxes at a rate of 39%, which again isn't surprising since we have a progressive income tax system and our overall profitability has decreased. So our tax rate has decreased, and a lower tax rate, that's a good thing. And the overall impact, a lower tax rate would offset, and our tax rate is now compared to the industry average. We can come over to our common size income statement and takes the tax expense on a percentage basis divided by our taxable income on a percentage basis, and we see on average the industry is spending 49 cents. So we are better than the industry average. After we've put together our template or done our analysis, we can finish writing up our written ROE decomposition. Again, we start off repeating our first sentence from the paragraph above. Oftentimes when we're talking about what's going on with profitability, it's nice to let the reader know something about our sales growth, because if sales are falling, that means we probably are facing business difficulties and don't have much pricing power, and that might explain why we've had to lower prices and profit margins have gone down. On the other hand, if we've got strong growth, that can give us information about why perhaps ratios have changed as well. So again, repeat that first sentence. The next thing you do is you need to tell me which factors contributed to the overall trend and which ones offset the overall trend. So the factors that contributed were rising cost of goods sold, SG&A, depreciation expense, and interest expense as a percentage of sales. And there it is, cost of goods sold, SG&A, and depreciation expense and interest expense as a percentage of sales. Then tell me which factors offset. The partially offsetting factors were a declining tax expense as a percentage of sales and a declining tax rate. And those were our offsetting factors. Now I want at least one sentence on each one of these contributing and offsetting factors. So our cost of goods sold went up as a percentage of sales, which is the same thing as saying what? Our gross profit margin decreased. And you could give me the ratios if you want. So you can either tell me that our gross profit margin went from 42% to 34%, or again, you can talk about cost of goods sold increasing from 57 cents for every dollar up to 65. They're one and the same thing. You don't need to tell me about both. I've told you about both here, but really both aren't required. But there's my sentence saying what happened and how does it compare to the industry. And in this case, we might be facing either higher product costs because our cost of goods sold has gone up, or it could be that we've just started competing for market share. Remember our huge increase in sales? One easy way to increase sales is to lower our selling price. And lowering our selling price, of course, would result in a lower gross profit margin. Next, I'm going to want sentences on SG&A, depreciation expense, and interest expense. So, compounding our problems, LA Gear's rising SG&A and depreciation expense as a percentage of sales. SG&A went from 23 cents on the dollar up to 26.3% in year 3. And that's roughly in line with the industry averages. And we can see that here on our common size income statement. Next, tell me about depreciation expense. Depreciation expense went from 0.2% of sales to 0.38%. So depreciation expense increased slightly from 0.2% to 0.38%. And we can also tie that to our fixed asset turnover. We incurred, relatively speaking, a big increase in plant, property, and equipment, which would explain our slight decrease in depreciation expense. If we look at our balance sheet, there's net plant and equipment. It went from 3,000 to 23,000. So sales tripled, but plant, property, equipment went up almost eightfold. And we also saw that with our fixed asset turnover ratio. We were generating 71 cents in sales for every dollar in fixed assets. Now it's 38 cents. So higher fixed assets would explain an increase in depreciation expense as a percentage of sales. One thing I do note here, though, is that notice we have very little in the way of plant, property, and equipment relative to sales. Gross plant, property, and equipment accounts for about 8% of our assets, net 6%. So obviously, we don't have a lot of plant, property, and equipment. We're not manufacturing shoes. We're most likely outsourcing them. Next thing I want to do, I want a sentence that's going to tell me about what happened to our interest expense. Recall our interest expense as a percentage of sales went from 1.83% to 2%. So there's our sentence. Interest expense increased, and that's going to likely be due to higher borrowing costs because if you recall, overall, our financial leverage has gone down. Specifically, if you look at our balance sheet, you can see the big increase in our line of credit. Then finally, tell me about these two offsetting factors, our tax expense as a percentage of sales and our tax rate. So again, if we were looking at our common size income statement, our tax expense as a percentage of sales decreased from 6.8 to 2.2%. There it is right over there. And this is, again, lower than the industry average. And our tax rate dropped from 41% to 39%. So again, first paragraph restates what happened to profit margin. First sentence. Next sentence or two identifies the contributing factors as well as the two offsetting factors. Then separate sentences about each one of the contributing factors and separate sentences about the offsetting factors. This setup will keep your thoughts organized and will allow the reader to better understand what is going on.